Hi everyone, welcome to ACCA P6 UK lectures. In this video we are going to look at chapter number 3 from the lecture notes, which is property income. I've just made a summary of how the property income is calculated on the board. So property income basically means that if you hold a property within the UK and you have let that property to the tenants, so whatever sort of rent which you are receiving, on that rental income you will have to pay some tax. Right, and that tax, which is property income, that tax will be put under the non-savings income while making the income tax pro forma, and it will be taxed accordingly according to the tax bands. All right, so basically how to calculate the property income. We will first take the rent. So when we have let the property to someone, of course they're going to give us some rent. So we'll take the rent and then we will add premium into it. Now premium means that sometimes what happens is that you have a property which is on a very special area within the London or within, you never know, within the Edinburgh, Glasgow or any famous city, and that area is very, very special that everybody wants to have that property. So that is a premium area. So when you have a property in a premium area which is very, very famous and everybody wants to have that property, then what would you do is you will say that whoever wants that property, of course they will have to pay monthly rents, but on top of that they will have to pay some premium as well. So premium basically means that it will be non-refundable advance payment. It could be £50,000 or £100,000 depending on the type of property and the location where it is located. So premium basically means that they will pay you some amount to secure that property, and that amount will be non-refundable. So that will be also added. So we'll take the rent and we'll also add the premium into it, and of course we will have to deduct some expenses which we are incurring on that property. And please remember, we can only deduct the revenue expenses as far as taxable income is concerned, as far as property taxable income is concerned. Alright, so we'll take rent, then we'll add premium into it, we'll deduct the revenue expenses, all sorts of revenue expenses, and whatever the profit is, we'll have to pay tax on that. If it is a loss, then we can set off the loss against the property, future property income, profits of the future property. Right, and if there is a profit, of course we'll have to pay tax according to the tax bands. Right, now in these expenses there is a list of expenses given to us on the lecture notes on chapter number 3. So if you open your lecture notes, please, I will also take my notes as well through the iPad. So there's a list of expenses given, and it could be all of them expenses. There could be other expenses as well. That's your own judgment. You have to decide that whether it is a revenue expense or the capital expense, because capital expenses are not allowed. Only the revenue expenses are allowed. Alright, now a couple of the expenses which seems a little complicated and which have some additional rules attached to them, so we will explain them expenses in detail. One of which is replacement of domestic items relief or replacement of furniture relief. So we will see in details. Likewise, another is finance cost as well, which is recently introduced, especially in Finance Act 2017. Finance Act, when the property is mortgaged. Right, so when you have the property and you are paying some mortgage as well, you are paying some interest through the payment, in the shape of monthly payments. So whatever the amount of interest which you are paying, whatever amount of mortgage which you are paying, the relief is restricted to 25% of that amount. Right, so we will see that as well, that how to calculate. Let me pick up my iPad, and in the meantime you also open your notes so that we can go through the lecture notes, chapter number 3. So I have my lecture notes in front of me. If you come to page number 10 of your P6 notes, it's chapter 3, property income. So on income, it says we'll take the rent, and please remember we'll take the rent on accruals basis. I hope that at this level you know what the accrual bases are. So we'll take the rent on accruals basis. We'll add a premium into it, and we will deduct all the expenses. Please remember, only the revenue expenses can be deducted. Capital expenses cannot be deducted, so only the revenue expenses. And also remember that expenses will also be on the accruals basis. So all the expenses which we will be deducting will be on the accruals basis. So the list of expenses are repairs and maintenance, advertisement, agent fees. So see that these are the common ones: bad debt, water rates, council tax. Council tax basically is a tax within the UK which you pay on a weekly or monthly basis to to get some facilities within your local council. So they are provided by your local council, for example, garbage picking and all that. So there are few facilities provided by the local council, local area, and in exchange of some charges. So that is called council tax. Likewise, water rates as well, redecoration fees, and then it says interest paid on loan. So that is the thing which I was telling you about earlier. It is a new rule introduced in Finance Act 17. So interest paid on the loan. When you have taken a loan and you have bought the property, basically that property is under mortgage and you're paying some interest on that. All right? We'll see additional treatment to that in a minute. Then other revenue expenses and replacement of domestic items relief as well. That is also worth some details. So we'll talk about it as well in a minute. Sorry. Right, then after that it's property profit or property loss. Then it says capital expenses are not allowed as property expenses. We cannot deduct them. Depreciation as well is not allowed. And then it says if there is a property loss, it can be carried forward to set off against the property income of the future years. Right? So basically it was exactly the same thing which I've listed here. I've just made it a short summary of what was given in the notes. So now we'll look at note number 1. Which I told you earlier. It is interest on the loan. All right. So one of these expenses which we will be deducting, one of the expenses will be the interest which you pay on the mortgage. All right. So basically, mortgage means within the UK, when you like some house, you go to your bank and say, I like that house. I want to have that house. If you could buy that for me, I will pay you installments. And until I clear my balance, the house will be on the name of the bank. So when you have cleared the balance with the bank, then house will be transferred, house ownership will be transferred to you. Right? So basically that is the mortgage. Of course, when the bank is buying that house on behalf of you, then of course they will be charging some interest because you will be paying installment to the bank, and eventually you will be the owner of that house. So of course the bank is going to be charging you some interest. So that's what we are talking about, that interest. Right? So finance cost relief, it says such as mortgage interest, incurred on purchase or repair of residential property. Please remember, it is residential property, not the commercial property. Right, so only the residential property is restricted to 25% for current tax year 17-18. They are thinking to increase it in the future years, but for current tax year 17-18 only. Restriction only applies to individuals, and it does not apply to the basic rate taxpayers. So if you are a basic rate taxpayer, this restriction of 25% does not apply. And it also does not apply to companies, only to the individuals. Also, there is no restriction on furnished holiday letting and property other than residential property. I already told you that there won't be any restriction on the commercial property. It is only on the residential property. And also there is no restriction on the furnished holiday letting. Right, so what would be the treatment of it? So we will take the rent, and if there is any, of course, if there is any premium, we'll take that as well. So while deducting the expenses, if there is only this expense of the interest, then of course we will deduct that. But chances are there will be some other expenses as well. All right, so we'll deduct the other expenses, and while deducting this interest, which we are talking about now, while deducting the interest, we will only take 75% of that. We will only take 75% of that, and that will be deducted, and it will reduce our rental income. It will reduce our property income. All right? So whatever the eventual amount is, that is the amount on which we will have to pay tax. Right? So on that amount, that profit which we will calculate, on that profit we will calculate the tax liability. Whatever the tax liability will be, that liability will be reduced with the 25% relief. All right? So how to calculate that relief? So whatever the amount of that interest will be, we will take 25% of that, and relief will be at the basic rate. So basic rate of tax is 20%. Now this commentary which I've just made, it might seem a little odd to you, but don't worry, we will do a question in a minute, then we'll understand it in a better way. So I've listed a small example underneath, which says that Mark, so Mark is a taxpayer, received £10,000 of annual rent, so that's his annual rent, and incurs £200 in expenses as well. So that £200 is per month basis. It's not annual, it's per month. So the expenses are per month. However, the rent which he has received is annual rent. So annual rent is £10,000 and he is incurring expenses £200 per month, which means annual will be 2,400. Right? Then it says that he pays £3,000 in annual mortgage interest as well. So that is the interest, that is the expense which we were talking about, 75% and 25% allocation. So basically the relief will be restricted to 25% only. However, the cost will be 75%, the other bit. Alright, so altogether it will be 100%. So we'll do this question now, and then you will understand it in a better way. And his other income is trading income of £70,000. So calculate his income tax liability. Right. So in order to calculate his income tax liability, first we have to see that he's got trading income. So we know that he's got some trading income, and he also got property income. For property income, we'll have to do working, so we'll have to do the working for that. However, we know that the trading income, which is other income, trading income is £70,000. So that is our trading income, and property income we have to do the working anyway. So basically that is the amount. And we know that both of these are non-savings income, so we do not need to make the full pro forma of non-savings, savings and dividend, because we haven't got any savings income, and we do not have any dividends either. Alright, so that's how we will make the income tax pro forma initially. Now we need to calculate the property income, and in order to calculate the property income, the information is given to us, so we'll do the working. So I will make the working here. So that is our working one, and it is our property income. Right, so property income, he's got rent. So he got rent of how much? He got rent of £10,000. £10,000 is rent. Then he's paying £200 per month expenses. Which expenses are these? Just the expenses basically. So expenses are £200 per month, which makes total of 2,400, 2,400. And he's paying £3,000 in annual mortgage interest as well. So I'll write it down here, mortgage interest. So mortgage interest is also being paid. So please remember that when calculating the mortgage interest, whatever the total amount of that is, we'll take only 75% of that. So how much is the total amount? Total amount is £3,000. So we'll take 3,000 multiplied by 75%, because it will be restricted to 75%. Basically, the restriction for relief is 25%. So this is not the relief. We are taking the cost only. We'll take 75% of the cost, but while reducing the liability, while taking the relief, that will be 25%. All right? So we'll take 75% of that. So whatever amount, whatever the 75% is, we'll take that amount, and that will be our, the rental income. So let me do that as well on the calculator if I've got here. I'm sure I got the calculator in the iPad. Just give me 1 second. Right, so that is £3,000. So 3,000 into 75%, sorry, 3,000 into 75%, it is 2250. Please make sure you redo these calculations, because I'm not too good on the calculation. So plus 2,400 pounds, which makes total of 4,650. If we deduct 10,000 out of it, that gives me 5,350 pounds. So 5,350. That is basically my my property income. So this 5,350 will go here. So 5,350, that is my property income, which makes total of 75,350. 75,350. So that is my total income. All right. We'll have to deduct the personal allowance out of it. Sorry, that was net income. So we'll have to deduct the personal allowance out of it. So personal allowance, we know that it is 11,500. So we'll deduct the personal loss of 11,500 out of it, and let's see how much is total. 75,350 less 11,500, which gives me total of 63,850. So that is 63,850. So that is basically a taxable income, and now we have to calculate the tax liability on that. Right? So that is a taxable income. And now we'll have to see the tax rates that up to 33. Just bear me one second. Let me see. I'm not good on memories. Yeah, 33,500. So 33 up to 33,500. It's 20%, and on top of that, it will be 40%. All right. So basic rate is 33,500. So we'll have to see 33,500 at the rate of 20%, and 63,850 less 33,500. So whatever the balance is, it will be at the rate of 40%. So that is our, whatever the amount is, that is our tax liability. Right? Now we need to give that relief which we have earlier said, this property income mortgage interest relief. So finance cost, we can say, or mortgage interest. So finance cost relief. So finance cost relief will be 25%. As I said, it will be restricted to 25% for our current tax year, which is 17-18. All right. So how we can calculate it? We'll take a total amount of interest, which was £3,000, multiplied by 25%, multiplied by 20%, which is the basic rate of tax, because relief will be given at the basic rate only. All right. So 25% of that will be 750, I guess. And if we take 20% of 750, it's going to be £150. If I am not wrong, please make sure you redo these calculations. So this £150 relief will be given, so which eventually will reduce our tax liability, and whatever the net amount is, that is basically the tax liability of Mark for our current tax year. Current tax is 17-18. So that is basically tax payable, you can say. So that is tax payable of Mr. Mark for current tax is 17-18. Right. So that was our the mortgage. So basically, why I did this example and why I have put this example in the notes, just to explain this bit of mortgage interest. So whenever the mortgage interest is given, so we'll take 75% of the cost, and we'll deduct the cost out of the property income. And while calculating the income tax liability at the end of the question, we'll have to give the 25% relief for our current tax year, and that relief will be at the rate of basic rate of tax. And please remember, because in this question the taxpayer was higher rate taxpayer at the 40%, he's paying tax at the rate of 40%. That's why this restriction is applied. That's why we did this treatment and that treatment. However, if he's a basic rate taxpayer, then this treatment will not apply, and we will do just in the simplest way, like we deduct the other expenses. All right. So we do not need to take the 75% and 25%. Only it applies to when, all right, and also it only applies to the residential property, not to the commercial properties. Right. So that's our property income and the mortgage. Now, before I just wind up this lecture, let me look at another bit as well. If you come to page number 10 again, please, that is replacement. At the end of the page 10, there is replacement of furniture relief, or sometimes known as domestic items relief. So basically, domestic items mean that whenever you are replacing something within the house with the new item, then this relief will apply. Not when you are buying the new item, but only when you are replacing the old item. All right, and the old asset and the new asset must be of the same category. Then this relief will apply. Initial cost of buying the new furniture is not deductible. Only the cost of replacing the old furniture is deductible, and relief will be reduced by the proceeds of the old asset sold. So whatever amount you have sold the old asset for, that will be deducted out of the relief which we have, which was given in our current tax year. All right, it will reduce. And after that, it says that new and old asset must be the same in order to get the relief, and property need not be furnished to avail the relief. So it doesn't matter if the property is furnished or not. The replacement of furniture relief will apply, and it does not apply to the furnished holiday letting. Furnished holiday letting basically is another type of property which we will see on the next page, possibly in the next lecture or even the lecture after that. All right, for now, that's it, and that's end of our basic property income. The only new thing from the previous tax year is this bit, mortgage interest. If you can do that, then that's fine. Apart from that, there isn't anything new, and I guess there isn't any technical thing as well apart from that. All right, now just one more thing before we close this lecture. I've confirmed from ACCA that the exam structure of ACCA P6 paper has changed. Now in the introductory lesson, because I was not sure at that time, and I haven't received the confirmation at that time from ACCA with regards to the change in the exam style and exam structure. Now I have confirmed from ACCA, and exam style of ACCA P6 has changed. There's just minor change with regards to the options which were given earlier. So in first section there will be 2 questions, one will be 35 marks and other will be 25 marks. And in the second section as well, there will be only 2 questions, 25 marks each. In the previous versions, there were 3 questions given in the second section, and you had choice to choose from 3 questions. You only had to attempt 2, whereas in the current version, you will not have any choice at all. So you will have to attempt all 3. You will have to attempt only all 2 questions in the section 2 as well, because only 2 questions will be given. There won't be any choice. All right. And to be fair with you, if you look at my earlier lectures as well, I always say that this choice which they give in ACCA of the choosing between 2 questions is always not beneficial to the students, because it only wastes the time. Because in the given time, you already are so panicked, and you do not have ability to choose between different questions. You will just randomly choose, and even if you choose one, you sometimes think, I have made wrong choice. So I would say that is a good news. It's just take it as positive step by ACCA. So don't think like, oh my God, we will not have any choice at all. What will we do? You have to study the whole syllabus anyway, all right? So that was the latest update with regards to the exam style of ACCA P6. So you do not have any choice. From June exams, you do not have any choice at all. You'll have to attempt all questions. All right, so that's it for now, and I will see you in the next video, and we will do a past exam paper which was examined in December 2015. So I'm too excited to start the exam kit. I know that you are as well. So I will see you in the next video, and we will start a past exam paper from the exam kit. Please make sure you have the BPP exam kits in hand, because we will do a question from that. All right, I will see you in the next video then. Goodbye.